Let's start out with Donald Trump and his tweet. Oil, as a result of OPEC's production cuts, is too high, says Donald Trump. What pressure could the U.S. actually bring to bear when it comes to OPEC?
Well, it's pretty limited right now, because when we think about the ability to physically increase supplies out of the Permian right now, you're constrained by pipe capacity as well as pressure pumping oil service capacity. Right. The most recent numbers are roughly 1.1, maybe 1.2 million barrel per day growth, and getting higher than that's going to be difficult. The other avenue would be the SPR. That requires congressional approval, and typically it's used under emergency situations, and I wouldn't call this an emergency situation.
So you have a price target on Brent of about $82 a barrel, I think you said.
$82.50.
$82.50 for June. When I left the office this morning, it was at $74 a barrel. Is it time to lift that price target?
Well, let's go over what drives that price target. Driving that is the underlying demand environment. Look at the high prices in oil are also high prices in metals. Yes, there's a lot of focus on geopolitics right now, but global demand growth is absolutely stellar, particularly given where we are in the business cycle. We're a late economic business cycle, and that's typically associated with strong commodity demand, hence why metals and energy are hitting multi-year highs. All
right, strong demand for oil, but is there a risk that the higher price starts to eat into that demand?
Actually, what we find, it actually works the other way around, meaning that you'd have to get to really high prices from here before you start to see it damage demand. And the reason why that happens is that what we see going back over the last 15 plus years is that higher oil prices lead to creation of global excess savings in places like right here in Abu Dhabi. That global petrodollars that then get lent out that stimulate demand growth. The point I like to say is, let's go back to 2000. Every macroeconomist told us if oil prices go above $40 a barrel, global economy is dead. What happened? They hit 50, 75, 100, global growth accelerated. We go back to 2015. Economists told, look for the tailwind to lower oil prices. What happened? Global growth really slowed. We go back up to 70, and hey, financial conditions were the best we've ever seen in first quarter of this year.
So is there any risk to the oil price at the moment then?
I think a couple areas that I would argue is a substantial risk. One is a slowdown in the underlying economic environment. There are signs, concerns in China right now, and you take the macro data, they have slowed. Our current activity indicator out there has slowed from roughly a peak of 5.5 earlier this year to roughly around 4.7. That's not worrisome, but if the trend continued, we would take that strong global demand growth that is excess of 2 million barrels per day year over year and start to ease up on it. So that would be my big concern.
So I'm sure Donald Trump would like to know what you think OPEC's appetite is for over-tightening the market.
Well, in terms of thinking about the current environment, they don't have a lot of competition coming from the oil patch in the U.S. As I said before, they're constrained physically, but they're also constrained financially. We look at their financial metrics, they have to improve. The industry needs to restructure. In fact, I heard a good one the other day is, how many CEOs does it take to drill a well in the United States? The answer is 600 right now. The industry needs restructuring, and so the financial metrics need to improve in the sector.
All right, the other hot topic is, of course, what's been going on with metals, given the Russia sanctions. How soon would you expect to see closures of aluminium smelters and plants as a result of the sanctions on Rusal?
In terms of looking at the flow of metal, it has mostly stopped right now. And in terms of the reasons for that is that assets were frozen of Rusal. And that had a substantial impact in the ability to transfer payments, which then led to the stoppage. More important than the aluminum itself is what's going on in alumina, the input that goes into the smelters. You lost roughly 7 million tons on a 120 million ton market. Now, here's the important point about alumina. You can't store it. So you cut production, you cut output immediately. And what that is going to do is going to hinder the ability for U.S. smelters to restart off the back of the tariffs. There was 2 smelters scheduled to restart, and you have to ask, where is the alumina going to come from? So this is a very disruptive dynamic in aluminum. In fact, I like to call the U.S. sanctions in aluminum, it's an economic cruise missile. It hit directly and is having a significant impact on global trade flows.
So do you start adjusting your price targets for aluminum?
We just recently raised it to $2,500 a ton with potential spikes up to $3,000 a ton, really driven by what's going on in alumina right now. I think when we think about about the solution further out, it's a combination of redistribution of assets, and part of the reason why aluminum is off, the Kremlin has already announced potential nationalization of the assets, and then the other one's a redirection of global supplies. We're already beginning to see that happen. We saw that with the Iranian sections as supplies get redirected. The system will find a new equilibrium. The question is how long.